WebEx 2025 keynote session. Let's jump right in. Please welcome to the stage, Maelstrom Arthur Hayes.
Hello, everybody. Happy bull market. Although I guess Bitcoin is kind of falling a bit, but Ethereum's up, so that's all good. So today I'm in Tokyo, one of my favorite cities in the world. As some of you know, I spend a lot of time in Hokkaido, so I come down here quite often, and it's great to be able to speak today. And what better time than to talk about my favorite thing, stablecoins. So the title of this presentation is called Buffalo Bill, and it'll be apparent why I chose this title in a second. And I'm going to talk about the macroeconomic impact of stablecoins, specifically dollar-pegged stablecoins. And then we're going to talk about 4 particular DeFi projects, which I believe are going to power returns in Maelstrom's portfolio, of course, and across the world. So I don't know if everyone has seen this movie, but it's from the 1990s. Maybe I'm dating myself here a bit, but it's from The Silence of the Lambs, Anthony Hopkins, Jodie Foster, and the man that you see here is a serial killer named Buffalo Bill. And in this particular scene, he has someone in a well, and he's shouting down to them, "It puts the lotion on its skin or it gets the hose again." And so I had a thought, and when I was running, I was like, oh, this would be a great meme for U.S. Secretary Scott Bessent. And if you've been reading my writing, you know that I called him the BBC, the Big Bessent Cock, because he's been fucking shit up all around the world, and he's only been in the office for 6 months. And so I wanted to put this in the context of stablecoins, and so I changed the meme a bit, and it puts the dollars on its skin, or it gets the sanctions again. And I'll come back to this theme at the end of the presentation, and you'll understand why. So U.S. Secretary Buffalo Bill Scott Bessent has a problem. And it didn't really start with him. It started way back in 2008. And if you remember, in that bleak and terrible time during the global financial crisis, the American financial system exported this calamity around the world. And the authorities in the United States had a choice of how they were going to deal with this particular crisis. Now, if you go back to the 1930s and the Great Depression, to the Treasury Secretary at the time named Andrew Mellon, he was of the mind that when you have this sort of credit boom and collapse, the good thing to do was to expunge the wickedness from the system. Let people go bankrupt, let the creditors take over businesses so that the country can start again anew and fresh, and you can grow out of this crisis. Now, obviously, that was not very popular because himself and his boss, the President Harding, were booted out of office after 1 term. In 2008, Fed Chairman Ben Bernanke did not do that. He decided he was going to print a fuck ton of money and bail out the American financial system. And in essence, what America did was it defaulted on its obligations of treasury holders, both domestically and around the world. And the response from central banks outside of the Americas was to start buying gold. This is a chart from Ned Davis Research, and what it shows is that the nadir of gold ownership as a percentage of reserves on the central bank balance sheet bottomed in 2008, which is basically when the United States decided to default on its obligation of treasury holders. Now, I've been on record saying that why would you ever want to own a U.S. Treasury? Here is a chart of TLT-US. This is the long-term bond ETF, 20-year or longer maturity U.S. Treasuries. And I divided it by the price of gold, indexed that to 100 starting in 2009, right after Ben Bernanke started printing money. And what you can see here is that long-term treasuries versus gold, and we can put this versus Bitcoin, and it's even more dramatic, but versus gold have lost 80% of their real value since 2009. So yes, on a nominal basis, you probably made a bit of money buying bonds when the central bank is buying your bags. But if you own gold, you would have been up way more. And so this is what's propelling central bank reserve managers around the world to say, I don't want to take my reserves and buy dollar treasuries anymore. I want to buy gold. And this is a problem for Scott Bessent because he has a massive deficit to finance because his boss, President Donald Trump, wants to spend a shit ton of money. So Bessent's got a lot of problems. The eurodollar market, which is dollars held outside the US banking system, is this amorphous size. Some people estimate it to $10 to $13 trillion of deposits are sloshing around the world. There's no regulatory control by Besson or Jerome Powell or any of the regulators. They don't know what's going on in this eurodollar market. These deposits are not buying treasury bills, which is the thing that Besson is selling to finance the deficit. And even recently, we are starting to see that China is circumventing US sort of control of the dollar debt markets for developing countries by saying, hey, I think the deal was recently with Kenya, where they're going to redenominate their treasury debt into yuan, and all of a sudden now, developing countries don't have to worry about the IMF or the World Bank coming and shutting off their dollar swap lines so that they can, be under the control of the American empire. So the eurodollar market can finance things that the government might not want them to do because they can't control it. And the second thing is de-dollarization. I know people have been talking about this ad nauseum. As I said, it started in 2008. Central banks want gold, and people around the world in the global south, the developing world, they don't want to allow their masses to own dollars because they want to inflate away their debts with their own population and prop up their own companies. And so Besson can't really push dollars into this corner of the world because the regulators in those countries won't let him. So I just want to go a bit more on eurodollars before I talk about the solution. So a eurodollar is a dollar held outside of the US banking system. So let's say that you go to France and you can deposit $1 in Société Générale or a bank like that. That is a eurodollar. This system started after World War II because people wanted to avoid capital controls. Contrary to popular belief, the United States is not a capitalist place. It's an amalgamation of socialist, fascist, and capitalist practices. There were capital controls in the banking system up until the 1980s, stemming from World War II, which is encapsulated by Regulation Q. There are a lot of people trying to avoid these by banking dollars outside of the system, outside of the control of the US regulators. Russia, or the Soviet Russia, before it collapsed in 1989, it had to bank its dollars that it used to trade with the world in offshore banks. And these banks avoided sanctions by creating a eurodollar market starting in London back in the 1950s and 60s. And then finally, as the global economy grew after World War II, these trade flows had to get financed, and that was happening with dollars held outside the US banking system. Now, over time, the importance of the eurodollar market grew, and it had a lot of discernible impacts on financial policy within the United States. The Federal Reserve has written a few papers on this, and you can trace back many of the responses to financial crises because the Federal Reserve and the Treasury stepped in and lent dollars to these foreign banks to make sure that the eurodollar market was secure. So it's a bit of a bad pill to swallow. They can't control these dollars, but then every time these banks fuck up, they've got to go print more dollars and bail them out, even though they're not domestically controlled. And then we talked about the global south. As I always say, fiat is trash versus gold and Bitcoin. But if you have to hold fiat, the US dollar is the best. This is the Argentinian peso divided by the dollar. And as you've seen here, it's lost 97% of its value since the first time I visited Argentina in 2018. I go quite often to ski there in Bariloche, and I pay everyone on my staff in Tether because it's way more easy to pay them in a dollar stablecoin than deal with the fucked up banking system they have. So around the world, people in the global south, they want dollars. They want a dollar bank account. They want to earn a 4% treasury bill. They don't want to have a Filipino peso or a Malaysian ringgit or a Thai baht. They want dollars. But their local regulators won't allow them to get these dollars. So what is the solution? The stablecoin solution. And this is why I believe from a macroeconomic perspective, you have Scott Besson, Buffalo Bill Besson, and Donald Trump, and even now the Federal Reserve of the United States going out and saying stablecoins are a positive development. We should be researching this new technology. About 6 months ago, the Treasury Advisory Committee wrote a paper on stablecoins and their impact. And they estimated that the market would grow to $2 trillion over the next few years. I have a larger number, but I think we're all in the same direction. Stablecoins is a national policy of the United States. Why? Because it forces eurodollars out of the system into Besson's control. It provides a digital dollar bank account for the global south, and I'll describe how that's going to happen in a minute. And in return, what happens? And when I discuss how a stablecoin is constructed, you'll understand that every time a dollar comes into a stablecoin issuer that's dollar pegged, they go out and they buy a US Treasury bill because it earns a positive yield, and then they take that yield, and that's profit. So what is an acceptable dollar stablecoin, right? I'm sure there's lots of issuers probably at this conference who are launching a stablecoin. I don't really care about you. I'm talking about what is the US government going to support? So an issuer is going to accept dollars. They have a bank account. There's somebody called an authorized participant. And they say, hey, if you do some KYC, I know who you are, I vet you, you can send me some dollars. And then for every dollar I receive, I'm going to issue a unit of stablecoin. So there's $1 for every unit of Tether or USDC out there in the world. And then what do I do as the issuer, right? I'm just like a traditional narrow bank of the past. I'm going to take that dollar, and I'm going to buy a Treasury bill. Now, the Treasury bill yields essentially Fed funds, which is right now 4.25 to 4.5%. So now, the stablecoin issuer might have to pay a little bit of yield to the holder, but in Tether's case, 0. And now I earn this entire 4.5% spread. Now, this is an acceptable structure. Why? Because the issuer is buying US Treasury bills. And if you read what Besson has been saying on television and what he's been releasing via the US Treasury, they're going to issue more and more short-term US Treasury bills because that's where the demand is. A short-term Treasury bill has a maturity of less than 1 year. It trades as if it was cash. It's just as liquid. You can use it to trade derivatives. You can use it to buy stock. You can use it to get a mortgage. It's very, very liquid. And that's why everyone around the world wants this short-term yield. And it's guaranteed by the US government, which can never go bankrupt in its own currency. Now, obviously, no one wants to own a 10-year or 20-year or 30-year bond because you have interest rate risk. Well, how many dollars are they going to create in the next 30 years? Are they going to have another 2008 situation where they pump the world full of dollars and depreciate my treasury holdings? No. So I don't want to own that. I want a treasury bill. And Besson knows this, and so he needs to issue treasury bills and treasury bills and treasury bills. And he needs to find anyone he can to buy this stuff from him. Now, I'm sure you guys are all aware of Tether. They're the 19th largest holder of US Treasury bills. And really this trend started post-2020 when interest rates started rising and the stablecoin circulation really increased. And I've written before that Tether, the organization that runs USDT, which I'm sure you all are familiar with, is the most profitable financial institution in human history per employee. Tether has about 100 employees. I think last quarter they made something like $6 or $7 billion in profit. They're more profitable than Goldman Sachs and JP Morgan than ICBC, Bank of China. This is the best bank in the world because all they do is they issue a dollar, they go buy some treasury bills. Everybody wants to be like Tether and earn that kind of money. And Tether is doing the God's work for the US government by basically spreading dollars around the world. So we're going to see more people try to be like Tether. I still don't believe that they're going to be able to be dethroned, but that's another story. So what is the effect on euro dollars? So, Besson and his guys are thinking about what am I going to do about this. So the first thing is how do I get euro dollars out of these foreign banks and into stablecoins? So as a depositor, what are we always afraid of? We're afraid that the bank will default on their obligation. I'm going to go to the bank, I'm going to ask for my money back, and they're not going to be able to give it to me. But over time, we've seen every time the euro dollar bank has gotten into trouble, what happens? They go to the Federal Reserve, they get money for free. During 2008, the Fed secretly was lending out hundreds of billions of dollars to banks. We only know about this because people had to sue the US government for them to admit that they were secretly financing all these foreign banks who were about to go bust because of the mortgage crisis in 2008. So if you're a depositor, a large depositor of euro dollars, you're very confident that if something happens, the Treasury or the Fed is going to step in and guarantee your deposit. So you don't have any fear about leaving these deposits offshore. So the first thing that Besson will do, I think, is somehow insinuate that, hey, if SocGen or these other banks get into trouble, you come to the Fed, we're not giving you any money. That's your problem. Go talk to the ECB. Go talk to somebody else. And all of a sudden, if you've got billions or millions or however much money you have in a euro dollar deposit, you're like, there's no more guarantee by the US government. Why would I want to own this? Is there something else I can have which gives you the same flexibility. I still get this large dollar deposit, and I've got the implicit guarantee of the US government. Well, stablecoins are implicitly guaranteed by the US government because the stablecoin issuer, as I just discussed, either has a dollar bill and a registered and chartered US bank branch, and we know that there's 8 too-big-to-fail banks which have a deposit guarantee. And after the 2023 regional banking crisis, with Silicon Valley Bank and the ilk defaulted, essentially the Fed and the Treasury nationalized the entire US banking system, and now every deposit is guaranteed by the government, as long as it's in a US bank branch. So if I put my money in a stablecoin, it's either in a Treasury bill, the US government cannot go bankrupt, or it's in a bank deposit, which is guaranteed. So I'm going to take my euro dollars, take this 10 to 13 trillion, and I'm going to move it over into the stablecoin ecosystem. So now the stablecoin issuer's got all this money. What do? Well, I need to earn yield. Best is great. I've got a $2 trillion a year deficit to finance, and I've got to roll over like $9 trillion of debt. So guess what? I have all these T-bills to sell. You have yields you want to earn because you want to be like Tether and earn billions of dollars in net income profit. So why don't you buy my Treasury bills? And even more, even better for Besson is now he has this buyer at any price. And so what can he do? He can completely disintermediate the Federal Reserve. As you've probably seen on TV, US President Trump and Chairperson Jerome Powell of the Fed are kind of in this like publicity battle. Trump wants him to cut rates really fast. Powell says, no, inflation, I'm Paul Volcker. And Trump is lambasting him day after day after day. Too late, Jerome Powell. Well, Besson, if he says, hey, I've got $10 trillion, $13 trillion of demand for this debt I want to sell, but Fed funds at 4.5%, that's too high. I think Fed funds should be at 2%. So I'm going to offer my Treasury bill at 2% below Fed funds, and I have a buyer. Why? Because they have to buy it. Because if they don't buy it, then they can't make any money. And so all of a sudden, Besson gets control of the entire yield curve. Not only does he control sort of the notes and the bonds market where he issues debt, but now he controls the front end, and he decides where the short-term interest rate is, not the Federal Reserve, because he has a buyer at any price, and that is Eurodollar deposits escaping into stablecoins. And finally, he has full control over this. He has full visibility. It's in the US banking system. It's in a local bank. They all are reporting their statistics to the Fed and the Treasury, and he can control these flows where they couldn't control them in the past. Now, this is even more, pernicious effect on the savers of the global south, the people in the Philippines, in Indonesia, in Thailand, who want a dollar bank account, in Argentina. So what does everyone in the global south have? They have a big US tech social media account. They have Instagram, they've got Facebook, they use WhatsApp, they're on X, right? Even if you have your local equivalent, everybody still is using these Western, US-centric social media platforms. So back in 2019, Facebook tried to launch Libra. And some dumbass US politicians said, oh, no, that's not good. We don't want, the Facebooks of the world competing with JP Morgan and Citibanks on their home turf. We're going to ban this. We're not going to allow Facebook to do this. And the Federal Reserve called up Facebook and basically said, if you do this, we're going to fuck you. And so they didn't. But times have changed. Now the US government needs to finance these trillions of dollars of debt. And so they're going to allow Zuckerberg and Musk and these tech bros to offer a dollar bank account through payments in these social media platforms to everyone around the world. So now, let's take, for example, in the Philippines, there's somebody who owns a call center. They have their clients outside of the Philippines. They need to get payment. It's very difficult to deal in those sorts of things. Their client doesn't have pesos. The local banking system is all fucked up. So they say, no, pay me on WhatsApp and Tether. Great. Everybody's got a WhatsApp account. Everybody's got Tether. Now they can send and receive payments in Tether. Their workers are like, thank God, hallelujah, I'll take that Tether too, please. I can go to the village and I can buy more stuff with the Tether than I can with the Philippine peso. Or when I travel abroad, now I have dollars. I'm not going to get skimmed 20% when I go to the airport trying to change my pesos to another currency. So all of a sudden, all these people who always wanted a dollar bank account, who are doing so much things, jumping through all these hoops to get a dollar bank account, are getting it straight into their mobile phone. Now, what happens to the foreign central bank? They lose control of their money supply. They no longer can know what their citizens are doing. They have dollars. They no longer can inflation tax them. They no longer can force them to buy and hold their shitty government bonds, their shitty domestic equities. These people can go around the world and buy whatever they like. But obviously they're going to complain. Complain to who? Complain to Trump? Trump's going to say tariff. You're not going to let Facebook into your country? Okay, here's a 100% tariff on your automobiles. And all of a sudden that goes away. Or Scott Bessent, who has the power to unilaterally put sanctions on the dollar system on people, can sanction all of the political and economic elite of a third world country who have all of their dollars sitting in the US bank anyway, saying, oh, you're not going to let Facebook operate in the Philippines? Well, then I'm just going to sanction you and all your buddies until you guys decide that it's okay to let these tech giants offer this service. So I think very quickly you're going to see Facebook and these types of services roll out a dollar bank account in the form of a stablecoin on platforms like WhatsApp, and this is going to quickly proliferate around the world. Now, I estimate that there's about $4 trillion of demand deposits in the global south, excluding China, because China was smart and they banned these companies. And now these dollars are going to be given to the people who really want them. And all of a sudden, what are they going to want to do? They're going to want to earn a yield on those dollars, just like everybody else. And now Bessent has another $4 trillion of demand for his treasury bills that he has to sell. So that's great macroeconomics, but we're here at a fucking crypto conference. It's time to buy some fucking shit. What are we going to buy? What am I going to buy? You guys can do whatever you want. That's going to make money off of this trend. So how does stablecoins power DeFi? And as you know, myself and Maelstrom, we are very big in the decentralized finance space. Majority of our portfolio are in DeFi, decentralized applications. So I'm sure some of you have used a stablecoin before, but just, bear with me. When you stake a stablecoin, what happens? Right? I go to my local exchange and they say, hey, if you stake your USDT, I'll give you 3% or whatever it is. And so you go, okay, cool, that makes sense. So you connect your MetaMask or your Phantom wallet or whatever, or you're directly on your SEX account. You stake your stablecoin, and then what happens? You get back this S something, like SUSDT or SUSDC or SUSDE, the staked version of the stablecoin that you deposited. And this is an interest-bearing asset. Now it's in your wallet. It's an interest-bearing asset that you can take around the DeFi ecosystem. It's like a Lego block. And now platforms are going to allow you to trade this, to collateralize this, to lend against it. So by taking your non-yielding, base layer money stablecoin, you've converted it into a liability of some sort of platform who says, I will give you a yield on that. And they're going to take this asset and you're going to use it around DeFi. And so all of a sudden, if we've now banked $0 and we've banked millions and billions of people in the global south, we have all these new users who have basically collateral to do something on chain. And this is how I believe we're going to power the four things I'm just about to talk about on chain, because now we have trillions of dollars of collateralized assets, and we have millions and billions of more people who are going to use these things. So I don't know if you guys have seen this individual from Ibiza who blew up this summer. It's the final boss, some guy from Newcastle in, I don't know, where fucking UK somewhere. But the DeFi final bosses, who I'm going to talk about. So EtherFi, this is going to allow you to spend your stable coins in offline and online using our Visa card network. Athena is going to allow you to lend your stable coins, get a higher yield than just 2 or 4% on the T-bill that Bessent is offering you. Hyperliquid is going to allow you to trade your stablecoins. It's going to be the largest exchange in the world by the end of this cycle. And Codex, a new project that we are advising, is going to allow you to collateralize your stablecoins, especially from a small and medium enterprise situation. So what did I do? I constructed a very simple financial model. So I want to talk about some key assumptions before I step through these models. So I believe that this particular cycle is going to last until 2028. Why? Because I believe that Trump and Bessent and all the people around them are going to run the US economy hot, and every other country around the world is going to follow suit because they're all in competition with each other. Now, I don't really have a view on whether or not a Republican president or a Democrat president in the United States is better or worse for the world or for the particular country. I'm just going on a probabilistic basis. It's very difficult for a politician, especially in a late-stage capitalist democratic republic society, to actually hit all of their campaign goals. Especially if you hear Trump and his rhetoric, it's all about, the US economy has been on the wrong track since Nixon went off the gold standard in 1971. Well, that's 50 years of policy that he's trying to undo in 4 years. That's just not going to happen. You just will not be successful. It's going to take many, many years, if Trump is correct in what he's doing, to see the fruits of that. The voter, obviously, is not going to be that sort of forgiving. Maybe inflation is higher than they would like. Maybe the job market isn't that good because AI is taking the higher paying jobs that they otherwise would have got, and we have a stagflationary environment. Maybe. On balance, I believe that it's going to be very difficult for Team Red Republicans to carry the presidency in 2028 because the other party, all he has to do is just snipe at Trump. Oh, it's not so good under Trump. Well, what about under me? I'm going to do things differently. You're going to do the same shit anyways, but that's not what the voter thinks. Okay, my life isn't so good now. Let me vote for the other side. And in a very highly polarized society, the few people in the middle who vacillate between Team Red and Team Blue are going to decide the election. And I think that on balance, you're probably going to have a Democrat win in 2028. And what are they going to do? They're going to try to distance themselves, at least initially, from Trump's policies. And so I could see a muddling of messages to financial markets about the trajectory of fiat money creation, and that causing a large sell-off, because we're going to be so hyped on stablecoins and crypto being the means of things for governments around the world. And so we get this new administration in and the dying empire, and then everyone freaks out. So that's why I think 2028 is the height of the cycle, and I forecast things out to that date. I have taken, I like round numbers, base 10, so 10 trillion, right? We have, a possible like 20-something trillion of dollars that could flow into stablecoins. I think we can get to $10 trillion in stablecoin supply by the end of 2028. Now, where are Fed funds? Fed funds, I believe, falls to 2%. I think that, Trump and Besson have been on record saying they believe that the current rate is about 1.5% to 3% too high. And as we've seen, Jerome Powell just flip-flopped into the easing camp after the Jackson Hole speech on Friday. So I think Fed funds gets somewhere around 2% very quickly. And how do I get to 10%, 5% of the 10-year, which I'm going to use to discount cash flows back to the present? Well, the growth that Besson has put forward in his 3% plan of real growth by the end of his term in 2028, well, if we add that to sort of inflationary or low short-term rates of 2%, we get to 5%. So I think the 10-year is somewhere around 5%, and that's what I'm going to use to take my terminal value of cash flows and discount it back to the present. So I'm a cash flow guy. I love cash flows. I want to take what do I think that these cash flows are going to be infinitely in the future. I'm going to take this 5% rate, discount them back to the present. I'm going to say this is the cash flows available to token holders, right? All of these projects are going to be handing out revenue back to token holders via buybacks and other emissions. And so then I compare that to the current fully diluted valuation of the project, and that's my upside potential. So this is the framework that I'm going to present on these models on where I think these tokens could go in the next 3 to 4 years. So first, EtherFi, spend it. I've been around crypto for almost a decade, or over a decade, and we've been pitched on this idea that we should be able to spend our crypto at a 7-Eleven or a Lawson or whatever, right? And people have tried over the many years, and most of these situations are very high fee, high friction, difficult to onboard. Well, EtherFi has cracked that nut. I have an EtherFi physical card in my wallet, and I also have a mobile one on my phone. And now I can go to any retailer around the world that accepts Visa, which is pretty much everywhere, and I just tap my phone, and I can spend my stablecoins, I can spend my staked ETH, I can even borrow on top of my crypto if I'd like to do that, and spend this money. So now, with dollar banking across the global south, now they have a Visa card. So when they go traveling, when they go online to buy things, they can use EtherFi, and they can spend their money, just like everybody else. And so it's a usable bank account for the entire global south. So here's my model. I believe at the end of this, it'll pump up to 34 times. So let's just step through this line by line. Stablecoin supply, 10 trillion. I talked about that assumption. EtherFi cash vault share. So I think that they can get up to 1% of total stablecoin supply will be deposited on EtherFi as a deposit. Right now, it's about 7 basis points, or 0.07%. But EtherFi card has only been around for about 4 months. If you look at the chart, it's hockey stick growth. I think they really can achieve this over the next 4 years as people are on-chain and they want to spend their money. So that gets us to a vault supply of $1 billion. Now, EtherFi is just like a bank. So taking it back to putting on our TradFi banking hat, what do we do with deposits? Well, we have all sorts of financial services that we allow with a deposit. So what did I do? I went to JP Morgan's latest annual report, and I said, okay, how much revenue did JP Morgan earn on their total demand deposit base? And it's about 1.8%. So okay, if it's good enough for JP Morgan, it's good enough for EtherFi. And so we get to $2 billion of annualized revenue by 2028, apply our discount rate and our terminal value, and we get to $36 billion of cash flow that we have available to us as token holders to be received back as buyback. Now, right now, the current FDV of EtherFi is $1 billion, and that gets us to a 34 times price pump between now and the end of 2028. Next up, we have Athena. We're going to lend it. This is a strategy that I've been writing about for about 10 years. It's called cash and carry. And Guy Young at Athena read an essay called Dust on Crust in 2022, where I said, hey, crypto, why are we dependent on the US banking system to bank Tether and Circle's dollar deposits? I don't know if you guys remember back then during the Silicon Valley crisis when Circle depegged, because Circle had a bunch of money at SVB, and we didn't know whether that money was going to be wiped out because of the bank went bankrupt or not. So I was like, well, this is crypto. We have this thing called a basis trade where I short a perpetual swap or a fixed date futures contract. I buy some crypto, and I have a guaranteed, at least in case the exchange goes bankrupt, earning called the basis. Why don't we take this basis, collateralize it, create a synthetic dollar, and now I have this high-yielding, endogenous yield within crypto, and I can use this as a stablecoin around the system. So Guy Young and Athena, they created Athena, and it's been the fastest growing stablecoin. I think when I wrote this, about $13.5 billion of circulating supply. It was zero 18 months ago. Fastest growing stablecoin in history, and we are a founding advisor of that at Maelstrom. So I think ENA can pump 51 times by the end of 2028. So right now, Circle's market share is about 25% of stablecoin supply. As I said, I think that Athena is going to eclipse Circle as a number 2 stablecoin within the next 12 months. And so I say, okay, well, I think what's good enough for Circle is good enough for Athena. Let's put it at 25% of supply. It gets us to about $2.5 trillion of deposited money in the Athena ecosystem. Now, I don't want to get into the details of a perpetual swap, but there's a neutral rate. It's at about 10% because I said it there and people just copied what I did. I think that comes down to about 5% because you're going to have all this supply in the market, and to get people to use leverage, you decrease the price of leverage. So we get down to 5%. Athena takes a 20% cut of all interest paid through the platform, and that gets us to about $25 billion of income at a steady state going per year that we can discount back at 5%. We get to $500 billion, current FDB at about 10, and so we get to about a 51 times return for Athena. And I think you're going to see a lot more exchanges and people start integrating Athena into their offering, which is going to continue to power this increase in the price. And also, if the Fed and other central banks continue to cut rates, then this 5, 10, or 15% endogenous yield in crypto becomes very attractive for people who are yield-seeking, who said, oh, well, I was making 2%, but 10's better. And I kind of believe in this crypto thing as a new person in this ecosystem. So the unfortunate part about fiat debasement is that for people who don't have enough financial assets, it forces you to become a speculator. And I think that's absolutely disgraceful. But this is the policy of every single monetary authority around the world. So what do people do? They start to speculate. They say, hey, my job doesn't pay me enough to keep up with my expenses, but maybe if I hit the next shit coin, it's going to go up 1,000x, and then I can buy a car, buy a house, be able to go out to nice restaurants, whatever. So I become a trader. And now that I have all these assets on chain, well, I want to trade on chain. I want to trade somewhere that's going to let me just connect my wallet and just start trading whenever I like with no restrictions. Permissionless trading. I want to trade whatever I want. And so that's what Hyperliquid is developing. This is the largest decentralized exchange right now. They have about a 67% market share. And it's quickly growing against the centralized exchanges as well. In some of their new listings, the Hyperliquid perpetual swap or Hyperliquid spot market is more liquid than the Binance, the Bybits, the OKXs of the world. And so I believe that Hyperliquid, powered by these trillions of dollars of stablecoin, these billions of more users, becomes the most traded upon, most liquid exchange in the world by 2028. And obviously, in exchange space, you make the most money. Hyperliquid pumps 126 times. And so, again, Hyperliquid ADV share. Where did I get this number from? Well, right now, Binance, in their perp market, has about a 26% market share of all of trading volume. So I said, let's plug that in for Hyperliquid. They're going to take over Binance by 2028. And so we get to $2.6 trillion a day of average daily trading volume. This is leveraged, by the way. It's not like there's just $2.6 trillion of money on Hyperliquid. I think they have up to 100 times leverage. Maybe they'll even go higher in the future. So it's not that difficult to get to these big numbers. For example, the most liquid traded contract in the world is the euro-dollar futures contract, interest rate contract in the CME. And it's something like some quadrillion amount of notional contracts a year. So this is not that difficult to do. And so now if we take the current ADV and annualized revenue, we get that they make about 3 basis points net fee to Hyperliquid. And so we get to $258 billion of income per year. Now, why is Hyperliquid such a beast right now? Well, it takes 97% of its money and it buys back its token. So this is going straight back to us, the token holders. Put a discount rate on there, and we get to something around a $5 trillion market cap, and 41 times where it is today. So yes, these are big numbers, but the exchange space can put up these big numbers because we have leverage, because we have more people using on-chain derivatives, because they have capital on-chain that they have to do something with. And then finally, a project that we are advising is called Codex. This is stablecoin infrastructure for businesses. Okay, if we believe there's going to be all these new millions of people with trillions of dollars of deposits in stablecoins, how do regular businesses onboard this? How do they deal with, hey, they got to pay the tax man or some supplier in a fiat currency, but they want to accept stablecoins from anyone around the world? Codex has built a purpose-built blockchain. They've been live for a month or two. They've done already $100 million of flow through their rails. And what's most exciting for me is that if Codex is successful, this ushers in the era of triple entry bookkeeping, where I can verifiably prove that your expenses and revenue are correct in real time. And I can create income statements and cash flow statements whenever I want, and I can take this information that is true, and I can lend against it. Why doesn't the bank lend to small businesses? Well, you give them a 3-month or 6-month backdated view on what you did at one particular point in time. Everything is in paper and PDFs. It's difficult, and people are lying, and so I'm not going to lend you money. They'll just lend money to the national champion, or lend money to rich people, or lend money to the government. I'm not going to lend money to small, medium enterprises. So this is where Codex comes in. If we get to triple entry bookkeeping, if we get everyone on-chain using stablecoins, we can have all these new businesses and give them credit and allow them to expand, and Codex becomes the first true crypto bank. And this is why I'm very excited about this project and what the potential is. And so they have a TGE coming out in this fall, so stay tuned for that. I think it's going to be quite interesting. And so, as I've said, stablecoin DeFi, this is a once-in-a-100-year bull market. And this man is John D. Rockefeller. I think he's probably, apart from a king or a queen or a corrupt government official, he is the richest human ever relative to his time period. And obviously, he pioneered the market for hydrocarbons, for oil. We have a John D. Rockefeller Standard Oil moment right here. The US empire has decided that they need to finance themselves. They're going to use stablecoins. They're going to completely change the architecture of the global financial economy to fund themselves and use this new technology. And we're going to take these assets on-chain, and we are going to use them to spend, to trade, to lend, to collateralize. And that's how we're going to create this amazing bull market in DeFi between now and 2028. So I'm going to put that dollar bill lotion on playa. Thank you very much, everybody.
Thank you very much, Arthur, for your wonderful presentation. Now we are moving on to further session. Please smile at the camera, please, on the center of the stage. Thank you very much for your cooperation for a further session, Arthur.
Oh, no.
That's it for further session. Once again, thank you very much, Arthur. Please give him a big round of applause to Arthur Hayes. Thank you very much. ありがとうございました。それでは続いてのセッションが始まりますまで、どうぞ今しばらくお待ちください。Please wait for a moment until the next session is ready. Thank you.